You know, we need to talk about old age security, the clawback, the guaranteed income supplements, and so on. So let's take a look here. Old age security, the OAS is available to a Canadian citizen age 65 or over who has lived in Canada for at least 10 years after age 18. And if you're living outside Canada, you're still available to get the old age security if you lived in Canada for at least 20 years after age 18. Also, seniors must apply to receive the old age securities, and so you should probably make the application 6 months before turning age 65, so the government will have a chance to process your application so you get off the market on your 65th birthday with some cash from the old age security. Now, the next thing we want to talk about is the clawback, because you can get, for example, for the second quarter of 11, $526 a month. You know, and it changes quarterly, so we're in the $6,000 range in a year. But the 2011 clawback of old age security starts at net income over $67,668. So if your net income in 11 is over $67,668, 15% of that claws back your old age security. So by the time you're at $109,764, there's your $6,000 gone. That's a very bad thing. So I just have in your notes that what you want to do at age 65, 66, 67, of course, obviously, is try and keep your income below this $67,668. And things that are popping you over might be RRSP receipts and so on. So one thought is if you could take your RRSP out before you're 65 to get the number down, because when you're 72, you have to take out income through your RSP. It's got to be annuitized, and you got to RIF, you got to take the income out. So maybe if you take it out earlier, that will get it out before you have the clawback. And also, of course, you can make tax-deductible contributions to RRSP up to the age 71, assuming that you've got earned income. And the other thing you could do is you could transfer the income or the assets that are creating income to get you over the 67, like dividends or interest, into a corporation. That's got its own issues. You want to do rollovers, and you got to look at corporate tax. Just a couple of quick points there. Now, a couple of other things I just want to mention here is that if you do have a clawback in 11, for example, the problem is your 11 old age security gets repaid, but also your old age security starting in July of 2012 is clawed back. Based on 1/12 of your clawback in 11, so it's kind of like a double whammy. It's more like an installment. And now if your 12 income is going to be quite low, you can file for a waiver from CRA not to have this, in quotes, recovery tax withheld. Service Canada will give you an advisory letter informing you that this recovery tax in 12 is going to be withheld off your old age security starting in July and going all the way till June 13, by the way. And that recovery tax is indicated in box 22 of the T4 OAS. It is very frustrating to seniors whose income fluctuates. For example, if you do have a senior with a $500, just to use an example, monthly OAS payment, they would receive $6,000, for example, then have it all clawed back because the income was unusually high. And in the next year, you would continue to get the $500 a month for January to June, but starting in July, based on your previous year's income, that will all be clawed back, and that'll go right through for the next 6 months. So it is a pretty confusing situation. We need to warn our clients about that. So the next thing we want to talk about here is guaranteed income supplements, and I have that written down in my notes, and here it is. In a January 27th, 11 Federal Court of Appeal case, the court confirmed that the grossed up amount of your dividend is the amount of income that's used in determining, your total income to determine whether you get your GIS under the Old Age Security Act. And so that's that. The other thing that comes out of that is there was also a Tax Court of Canada case where the RSP withdrawal, of course, is also part of your income that blows out your old age security or your guaranteed income supplement. So a couple of quick points there. Now, the last thing is this paragraph 88 bracket 1D bump, because you've got Mr. A dying, and he owns the shares of Subco that owns Opco, and let's say it's worth $100. Well, he's got a capital gain. The estate's got $100 a cost base, and let's say Subco sells the shares of Opco. You got another $100. You got double tax. Well, what we've got is a technical interpretation where CRA says, you know what, you can avoid double tax by just having Subco, which is owned by the estate, transfer the estate transfer Subco to a parent company, and then you could have subco wound up so that the OPCO shares are given to the parent company, and you can now bump up the cost of OPCO shares because those are non-depreciable capital property, so you avoid the double tax. And CRA say that in this technical interpretation, and this is a combination of paragraph 881D, which is a bump, and some special rules on estates, D.2 and D.3. You can certainly take a look at that, and I have an example in your notes. So that's how you can get a bump up of non-depreciable capital property when there is a death by using a new company to acquire the shares, but it's only non-depreciable capital property. Okay, you can look at that. And if you really want to exercise yourself, read 881D, D.2 and D.3, because if you can understand on your first crack through, you are a genius. Anyway, all the details, by the way, are included in that particular technical interpretation. Sandra Snell of the Rulings Division gets involved in all these technical interpretations, and she's got all the detailed ifs, ands, and buts, because there are a lot of ifs, ands, and buts in getting this 881D bump. But so far, so good. So there you go. Those are some estate planning matters.